Hi, this is James Good with a special On the Money market update on the evening of July the 10th, 2012. Those of you who've been with me a while will know that I pay quite a lot of attention to price patterns in the stock market. By price patterns, I'm talking not just about classical chart patterns like the head and shoulders, or about breaks through trend lines, or about support and resistance. Used smartly, those kind of patterns can give you a definite trading edge, but I want to talk here about a different kind of pattern. The kind of extreme extension of prices in one direction or another, which occurs very rarely, but which can be tested historically, and which can be a tremendous clue to the market's future behavior that you won't find discussed anywhere else. And that fact alone can provide an amazing edge if you're one of the few people who can see a large move coming in time to take full advantage of it. Now, I believe I might have discovered something in that vein today, but before I reveal it, let me illustrate two recent examples of the kind of pattern that I'm talking about, so you understand just how powerful they can be, and so you can put what I'll show you later in some kind of context. Last summer, in the midst of the huge downdraft in August, right in the thick of the panic, I wrote an update on my blog called How Now Down Dow. Now, I'd identified this pattern in the weekly chart of the Dow, in which the entire bar, the high, the low, the open and the close, fell below its lower Bollinger Band. That's 2 standard deviations below its 20-week moving average. Now, it takes an immense amount of selling pressure to do that. So I wondered whether that likely meant that the selling couldn't be sustained. In other words, did it mean our market bottom was close? This was the big picture. In the midst of the panic, we were wondering how low was this going to go? So looking back right to the 1920s, I found just 8 similar instances. And yes, in each case, the Dow was either at or very close to a significant multi-month low. 1929, 1930, 1938, 1940, 1946, 1949, 1960, and 1987. Right near the bottom, these signals appeared. Some were generational lows, but all were worth taking advantage of for some time at least. Or for those who were balls to the wall short, it was a pretty serious signal to take your profits. Now, obviously, we now know that August did prove an amazing opportunity for those who wanted to get in for a big swing higher. 20% higher from the date of the post to the April peak. Now, here is the other example, which feeds directly into what I want to show you in a moment. In the lead up to Lehman's collapse in 2008, before I started this blog, I was trying to persuade a friend to get out of the market. Unfortunately, I failed, but one of the pieces of evidence that I sent him was this. This time I was looking at a monthly chart of the Dow, and at the end of August of 2008, I saw these 2 months. And this is a 2-month exponential moving average, and both these months opened and closed below it. Now, when prices deviate hugely from a short-term mean, as we just saw, there's often a snapback effect. So I thought I would check my data back to 1929, and I expected to find a few instances where 2 such months would mark a significant low. But what I actually found was that this was a sign not of upcoming strength, but of imminent weakness. There were just 7 examples in 80 years, and all but one led to a major crash. 1929, 1937, 1941, 1946, 1974, 1978 saw big downdrafts almost immediately after. The only exception was 1982, which was, of course, the big bottom. So those 2 squashed candlesticks were an innocuous sign, seemingly, but if you'd seen them and bothered to check, you'd have seen the market was giving off a major signal of distress, was telling you not to listen to the Wall Street chorus, telling you stocks were cheap, but to get the hell out of the market. And in the second video, I'll show you how, albeit on a smaller scale, the market might just have given off a similar kind of warning.